In this presentation, I'll share with you how I would go about creating an investment policy statement for a high net worth individual or the investment committee of an endowment. Let's start by looking at the word policy. What is a policy? Well, policy describes a course of action that a client will take in certain situation. It provides a roadmap for how someone will behave moving forward. And that policy should be aligned with the client's values and goals. Hopefully, you create the policy at a time of emotional calm, when decision-making can be clear, it can be based upon sound logic, as opposed to trying to create a policy in the middle of a market meltdown. Note that financial policies don't just have to be about investments. So when you're working with your financial planning clients, you may decide you'd like to discuss financial policies such as charitable intent. We will donate 5% of income each month to a charitable cause. In respect to dealing with debt and debt management, credit card balances will be paid off at the end of each month. Policies about systematic savings for investment will make the maximum allowable contribution to our 401k and our pre-tax IRAs each year. These policies can be very clear and important for your clients as they move forward towards their financial goals. And a very interesting paper on this subject was written by David Yeski and Elisa Bowie. It's called Policy-Based Financial Planning Provides Touchstones in a Turbulent World. Those policies are those touchstones, those anchors that the client can come back to. You can access this article through the CLU database. So let's begin our discussion about investment policy statements. What's the advantage of an IPS? Well, first of all, it provides a written document that describes how the client's assets will be managed. And within that written document, you're clearly outlining your strategies and the tactics that you'll be employing day to day or month to month as you implement the investment policy. It promotes clarity between the client and the asset manager, and you'll see more about this as we move forward. And it also documents the written agreement, and that documentation is important. It's a touchstone to come back to. It's an anchor during those periods of volatility when the client is shaken about how they might be moving forward. It also is a written document that can be quite valuable to help mitigate possible litigation. So what goes into the investment policy statement? As you can see on this mind map, there are several different areas, sections of the policy statement, which will help to clarify the procedures. These include the responsibilities of the client and the advisor. What is that underlying investment philosophy or that overall strategy? What is the recommended asset allocation based on the client data? What tactics will be used in putting into place or implementing that overall plan? What will be the procedure for monitoring and evaluating the advisor? And clearly communicating how communication between the client and planner, the client and the advisor will occur. Let's take a look at each one of these. And before we do, one other thought. Depending on the client, whether it is an endowment, a high net worth individual, or a new investor, the depth or the breadth of the investment policy statement can either be ramped up or it can be cut down some. So maybe with a brand new client, the policy itself, as they're just getting involved, maybe it's going to be a short document, but at least it becomes a starting point. And for an endowment, a high net worth individual, it may be pages and pages long, right? So we'll come back to this thought also as we move forward in the presentation. First of all, you define the parties of the IPS. In your work with your individual planning client, there'll be you, the advisor, you, the client, and possibly other advisors. In working with a trust or endowment clients, there'll be the advisory committee or the board, the investment manager, the investment consultant, possibly custodians and other fiduciaries. In this presentation, the focus in respect of building the IPS will be on the individual client planner investment policy statement. What are some of the responsibilities? Well, these will look familiar to you as you've been studying the comprehensive financial plan. The client will be providing complete data to you. They're responsible for letting you know of material changes. They will authorize the asset allocations and the investment policy. The client needs to be the one to exercise security voting rights. That he or she will be monitoring the performance of the manager, appointing fiduciaries, etc. The advisor, and hopefully that's you, will collect and analyze the client data, recommend the asset allocations, recommend the securities to buy or sell, implement the investment decisions, monitor those portfolio holdings, deliver the investment report to the client, meet with the client so that you can deliver and report what has been going on. Again, these should both look very familiar to the work you're doing creating a comprehensive financial plan. Moving into the next section, a very important section, the investment philosophy. This is where you communicate to your client your core investment tenets. These may include items like, we believe in using modern portfolio theory, which incorporates asset allocation over different asset classes and diversification within those classes. Our investment objective is for total return. Now, maybe it's growth or whatever. Total return is income and capital appreciation. You communicate your stance on active versus passive investing, or the combination of active and passive investing that you'll be using within the portfolio. What do you think about using portfolio insurance? And this is something you looked at in your investments and portfolio management class, the hedging of portfolios. Other tenets that you might be discussing is maybe the use of age banding methodology and planning for retirement, how you'll be rebalancing the portfolio. Do you consider overweighting any of the different exposures, international, domestic? And perhaps your strategies like dollar cost averaging. So as you can see here, you are communicating your beliefs about investing and what you'll be using in managing the client's account. So why is this section so important? And I've listed on this slide several reasons. First of all, it clarifies your investment strategy. It documents your strategy. It provides an anchor that you can come back to during times of panic when you say to the client, well, let's sit down and take a look at this strategy that's designed to build wealth over time. And that can be very useful to keep the client in the portfolio rather than selling at the very worst time. It aligns the strategic intent. You and the client are both coming from the same place. And if that's not occurring, it helps you see that red flag. If, for example, you believe in portfolio diversification and the client wants to go for return and hopes that you will concentrate it in one or two stocks, that's a real red flag. And that's the type of client or the type of misalignment that you need to make sure that you disengage from. Because it's important that you work with clients that are right for you. And that's sometimes hard to do when you're first getting started. But you will know at some point in your career that when you work for clients who have similar beliefs, attitudes, values as you do, it is a pleasure, it works, and when it's not aligned, there's all sorts of problems. Finally, I think the IPS is a wonderful education piece. It will help you in working with your client in that long-term relationship. And the client will come to know and incorporate important investment disciplines. Asset allocation decision. Now, as you recall from your introduction to financial planning course, from your investments and portfolio management course, asset allocation is the key decision when it comes to, as opposed to timing of markets, individual security selection. Asset allocation is incredibly key to accumulating wealth over time. And in this section, you'll provide the client with your recommended asset allocation, but you'll also include a lot more information in there. Remember, the asset allocation reflects the client's situation, including their goals, their tolerance for risk, their liquidity needs, their constraints and preferences, and their time horizons. Moreover, I think you need to be considering their investment knowledge, their experience with investing. And I think that's important. Share a quick story. A friend of mine from back east asked me to take a look at a situation of a friend of his. Looking at it, the person's portfolio had really melted down and there was litigation going on. And when I looked at the paperwork, this friend had said that she understood alternative investments, managed futures, options, and so they were put into the portfolio. And during the 2008-2009 market meltdown, that portfolio took a hit to the amount of 80%. And during the ensuing litigation, it came out that this client said that she didn't even know what a managed future was or what an option, how that was used. So we need to make sure that we understand what our clients are experienced in, and then as the knowledge starts to build up, then you can start to shift a little bit of what you're doing. But I think you need to really consider, besides the goals, the needs, the risk tolerances, the preferences, the constraints, the time horizons, tax issues, you need to consider the knowledge, prior investment activity, and also financial capacity to endure a market shake. As previously mentioned, the IPS can become an important educational tool. Now, this was part of a IPS that I had put together, and I just wanted to share with you that small section there to show you that in the first paragraph and in that first visual, I'm framing the spectrum of risk aversion. And then in the second paragraph, the idea that based on my assessment of your responses to my questionnaire and questions, I'm putting you in this part of the spectrum. Asset classes. Within the category, within this section, you'll be defining what asset classes will be allowed and not allowed in the investment mix. For example, you might say we'll be allowing cash, fixed income, equity securities, real estate, and some alternative classes. And of course, you would fill in what alternative classes will be in there, and also, in this case, domestic international securities. You'll also be outlining the assumptions, the expected returns, the standard deviations, and the correlations, because that information will be quite useful as you use an optimizer. And I recommend that you're incorporating this, as Dr. Basu once said, the artwork of modern portfolio theory, to show that, in fact, you're using optimizers to help you get started, and then you use your experience to fine-tune that asset allocation. And within this strategy section, I think it's important to outline your philosophy about rebalancing. Because rebalancing is quite important. It is effectively a discipline which makes sure the client is selling high and buying low. You're selling some of those securities that are, or those asset classes that are really taking off, and you're buying into those asset categories that are temporarily selling off. Also within here, you need to find what is that trigger for the rebalancing. What will cause you to rebalance the portfolio? Because clearly you're not going to stay, if it's let's just say a 60-40 mix, you're not going to sell as soon as you get to 61%. Will you use a fixed percent threshold? For example, if the portfolio moves 10% outside of the recommended asset range, then we'll rebalance. We'll use a percentage customized for volatility. Will you use a calendar where you're looking at it every year? You're looking at it and then you're rebalancing, or semi-annual? Or is a major market event, a market sell-off, or an upside move, a major upside move in the market, will that trigger it? As you bring that information into this section, where you define the different asset categories, you defined the recommended mix, you've defined what will in fact be that range that you'll allow before triggering the rebalancing, you're able to provide for the client a clear outline of how the portfolio is going to be managed. The image on this slide gives you an idea of what I did in one IPS, and you can modify it. Well, once you've defined the overall philosophy, the strategy, we move into the tactics. How will you implement the plan? And I think there's a variety of issues we'll be taking a look at here. So you've already defined the asset classes, and now you're looking at what types of securities within these asset classes will be permitted, what type of securities will not. How will the trading proceed? What are some of your disciplines for trading the portfolio? Looking at trade execution. And what is your security selection criteria? Again, full transparency, laying out your entire game plan. So security types. On this slide, I give you some examples of maybe types of securities that you're going to permit. For example, you're going to incorporate mutual funds and exchange-traded funds. Individual stocks and bonds will be allowed. Options, but in this case only for hedging the portfolio. Will allow managed futures, direct ownership in real estate, and shorting would be allowed in this case. On the other hand, perhaps you might prohibit certain securities like leveraged partnerships, venture capital, hedge funds, individual future contracts, options for the purpose of pure speculation, and illiquid securities. Of course, this mix will depend on your client, on the amount of assets perhaps that you're investing, their overall investment portfolio, how that looks, their experience, right? So you'd be looking at how full transparency on what will be allowed in the portfolio. From there, we take a look at describing your trading disciplines. Position sizing of any one security. For example, what percentage of the portfolio can any one security represent? On one hand, if it's so small, then it'd just be a large number of securities in there. If it's too large, if there was a gap down in that security, or the company went bankrupt or something, that could have a meaningful impact upon the portfolio, you need to consider the position size. And you may even take a look at mutual funds, but of course mutual funds would be a different situation than an individual security. It's already diversified. But you need to consider, I believe, you need to consider that position sizing. Maximum sector plays. Now, sector rotation is a strategy used by some investors, and in your macroeconomics for investments course, you started to take a look at business cycles and how different sectors react within different business cycles. And the question there is, how large a concentration will you allow within one sector? You may even discuss the types of securities that will be put in taxable accounts versus non-taxable accounts. And that's a concept that you covered in this financial plan development course, in your intro to financial planning course, and also in your investments course. You may also start to describe your trading execution. Will you only trade with cash? Will you use margin? And what are you doing to ensure best executions? Security selection criteria. How will you do your due diligence? What criteria are you using to identify securities that you'll include in the portfolio? Now, I've listed a number of items that you may be using in doing that. Maybe you're looking at the costs relative to alternatives, particularly if you're investing in mutual funds. And this criteria is something which you may have heard from John Bogle from Vanguard. The idea there that costs over time are one of the major differentiators between a future portfolio value growth. The idea of no loads versus load funds. What do you feel there? Will that be one of the criteria? Maybe that's different in equities to fixed income. So loads and fees may be an issue. Maybe you're looking at historical performance, historical volatility. Maybe you're using fundamental analysis or technical analysis or a combination of those two. Again, all concepts that you studied in your investments course. Are you weighting value versus growth? Are you using a combination of value and growth securities? Do you maintain minimum credit rating? Particularly in working with clients who are in retirement and are generating income. And you can see that you could be mix and matching those. There are other criteria you might be using. But again, clearly sharing with the client how you will identify the securities to be put into the portfolio. In this section of tactics, I think one other area that you need to address is how will you handle distributions from the securities, dividends, capital gains, principal? Will that be returned to the client? Will that be reinvested? And likewise, how will contributions be handled? When a contribution is made, will it be systematic contributions? Will it be an annual? If you receive the money in, will it be invested all at one time? Or might you then invest that dollar cost average that over 3-6 months? So at this point, you've defined the parties and the responsibilities of those parties. You've outlined the overall investment strategy. You've described your tactics for putting that money to work. And now it's the idea of, well, how will the portfolio be monitored by you? Well, because we can't monitor every day, and we don't want to monitor every day because that's just getting into the noise of volatility. Will you be looking at the portfolio quarterly, semi-annually, annually, although I certainly wouldn't go further than that? Or would you take a look after a major market event, a change in client situation? Not only the frequency of your reviewing of the portfolio, but maybe what criteria will trigger a security sell. Is it a specific period of underperformance to a benchmark or a peer group? And that brings us to that topic of a benchmark. What constitutes an appropriate benchmark? And within the portfolio, you'll be identifying some benchmarks that will be used to help the client assess how the portfolio is working. And I believe that when you look at benchmarks, they should be identical in asset class. They should be representative of the management style that you're employing, the geographical region that you are allowed to invest in or you're investing in, and also the market capitalization. If, for example, you're investing in high capitalization stocks versus a small cap, you would not compare the small cap returns to a high cap return, or a large cap, I should say. They should be passively managed, the benchmarks. And in other words, that's just the market. And that would take you into a concept like Jensen, right? The Jensen, and open to new investors. So the benchmark provides this overall sense of what you're doing, the market itself, and that becomes a reasonable benchmark for you. So you outline the benchmarks in the investment policy statement that would be used. But I have two sentences on this that I think are important to grasp. And that's, first of all, meeting or exceeding return expectations balanced against market realities is only one criteria used by the client to evaluate the investment manager. Because we certainly understand that in any given period, there's over and under performance. But I think the more important issue in any one period, because of the volatility and issues I just mentioned, is whether or not the manager did what he or she was expected to do. So yes, over time, you're looking at portfolio performance relative to these the overall market, the appropriate benchmark. But I think the most important item to evaluate within that given period is whether or not the manager stayed consistent with the investment policy statement, compliant with the IPS guidelines, directives, the asset mixes were maintained, adequate liquidity was maintained as described in the statement, securities that were not allowed were not put in. This is important. The last section of the investment policy statement is where you define how you will be communicating, providing feedback to the client. Typically, that's in some type of written report. And so you may describe the format of that report. In this case, I'm talking about an executive summary, a market recap, performance, perhaps year-to-date, 3-year, 10-year. Again, I think it's that accumulation of wealth over time that's important, not the daily, the volatility of those returns. Changes during the period, portfolio holdings, and by changes in the period, I mean inflows, outflows of cash, the current portfolio holdings, maybe holdings at the beginning of the period. And you also describe the frequency of the communication. Before we move on, and this is not really a focus of this presentation, but you're getting to performance presentation standards. I should say the CFA Institute maintains global investment performance standards. And in those standards, and I think they're pretty a standard benchmark for, or a guideline for the industry, time-weighted total return after fee and full disclosure of the calculation method. You may have help or someone is putting together these performance results for you, calculating them. Finally, signatures to the investment policy statement. I always think this is important because this is where you get the buy-in. When the client signs off, you know that they understand this, they're ready to move forward, and again, it's always something you can come back to if there was ever a situation of any type of mitigation that everyone was on board. As you can see here, I had included a few appendices in here, and you certainly could do the same as you build your IPS. So let's summarize here for a moment. I think in building the IPS, it really starts upon the idea that you're going to be giving the client data, reframing the situation. You're going to be assigning the responsibilities, and of course, describing your strategy, your philosophy. That philosophy really, I think, is that foundation of the investment pyramid here that I'm showing. Once you do that, you can describe your investment guidelines and your recommended asset allocations. Next, you'll describe how the portfolio will be monitored, how reporting back to the client will go, and of course, the acceptance by the client, the buy-in, the signature block. There's a wonderful resource for you in the area of creating an investment policy statement, and that is a book written by Norma Boone and Linda Lubbock. This book is available through the FPA Press, and you probably can get it online from one of the online book vendors. In this last part of the presentation, I wanted to share with you the idea that I think there's some real opportunities with the investment policy statement and in presenting that to your clients. In working with the individual client, again, I think the opportunities in writing and presenting the IPS is it clarifies your firm's core investment beliefs and strategies. Putting together the investment policy statement allows you to discover a lot of that information about what's going on inside your client, the quantitative data, really getting to an in-depth discussion and review of investments. It allows you to educate your client about investments. And that last one I think is incredibly important. In this conversation, in that work, in that education, you build a long-term relationship, because this is a collaborative creation, a collaborative effort in putting together the strategies, the tactics, the entire package. How do you present it to the client? Well, as I just mentioned, it's collaborative. It's a dialogue. And I think that conversation needs to be focused on creating a prudent and acceptable investment and saving strategy. So you're communicating to the client, you're listening, actively listening to what the client is saying to you, and you're starting to create this plan. Again, it's an educational opportunity that will help your client grow. And that's one of the reasons that the IPS will mature over time and maybe get more sophisticated, more asset classes being brought into the mix. And it ensures clients' objectives match your firm's investment philosophy. And likewise, the flip side of that coin, you're able to weed out some clients that really are not the correct match for what you believe and what you want to do in terms of managing and implementing that plan. There's, I think, also an opportunity in working with the investment committees of trust and nonprofits. The Uniform Prudent Investors Act of 1994 set a fiduciary standard of care on that board, on that investment committee. And this is really important. Again, I think this is a tremendous opportunity perhaps for you. It allows delegation by the boards and the committees because of the complexity of our investment world. But it requires stewardship on their part. So they still have to be the stewards, but they can delegate that investment process, that investment routine to you. And also, hindsight is not a measure of prudence. Rather, it's a review of the investment process. And this is important because the investment process really gets into creating investment policy statements and understanding that they're investing for total return, that they need to incorporate the tenets of modern portfolio theory, because MPT is considered a prudent method, a prudent strategy when it comes to investing. And of course, you know, MPT means diversification, asset allocation, portfolio consideration of portfolio risk and return. And also analysis going into the decision making, assumptions, cash flows. So investment is a process, and that process is really described when there's an investment policy statement. But I think there's even more help than that, the fiduciary and the stewardship issues. And that's some of the organizations that endowments are connected with are recommending that written investment policies be part of that ongoing process. Here's one from the Profit Sharing 401k Council of America, and I'm going to read this for a moment because I think it's quite powerful. The PSCA believes that the adoption of a formal written investment policy process and following and documenting that process will assist sponsors in the prudent management of their defined contribution plan assets and will help them avoid fiduciary liability. Without such a written policy statement, how can a sponsor demonstrate that there is a procedure for establishing and carrying out a funding policy in a method consistent with the objectives of a plan? Further, a well-constructed investment policy statement provides evidence that a clear process and a methodology exists for selecting and monitoring plan investments. In fact, the Department of Labor will routinely ask to see the plan's investment policy statement in the process of a plan audit. So right there, you're starting to see that the investment committee, the chairs of these committees, understand that in order to protect themselves, in order to make sure that the assets are being invested the right way, there needs to be a process in place, and they're looking for some help in putting together these investment policy statements. Here's another one. I thought this was quite interesting. Magazine of the New York Society of Associate Executives. And in here, it says a policy will help the nonprofit board exercise its responsibility to ensure proper care and management of the funds. This is very important consideration for donors, particularly the ones who donate large sums of money. No one is eager to contribute to nonprofits that suffer large financial losses or are victimized by a financial scandal. So when you help a committee, an organization, create an investment policy statement, that becomes a marketing tool. They're able to take that to the potential donors and say, look, we have a real process in place that your contribution will continue to grow over time. It will continue to promote a cause that we are both very committed to, and that has a lot of legs in respect to gathering assets. So not only are you helping that committee fulfill its fiduciary responsibility, but also you're appealing to potential donors. I think that's a real opportunity. Again, presenting the IPS, it's a collaborative dialogue designed to create that investment strategy, that process that will be used in promoting informed decisions. And you're the investment consultant. You're the one bringing that expertise and building this IPS. And whether or not you're involved in the management of some of those funds for that nonprofit or that endowment or whatever, you may in fact end up becoming the financial planner for some of the people sitting around that table, some of the board members. And that could be outstanding. A few final thoughts. The IPS is a dynamic document. Just like the financial plan is a dynamic document. That's because life happens. Situations change, goals change, needs change, time horizons are always changing. Also, the idea that in this presentation, I tried to provide to you how I would put together a plan for a high net worth individual where there's sophistication in there, or also what I would do in starting to build a plan for an endowment. You could also par down, as I said previously, you could par this down for the less sophisticated engagements. If you deliver a 50-page IPS to a new investor, it will be overwhelming. But you can clearly start to at least incorporate your discussions in those initial conversations about investing. You can start to put together a smaller document that will then start to expand as the client accumulates more assets, as their knowledge, their experience starts to build upon it. So it's dynamic, but these pieces shown in this map right here, I think all these pieces would be in it. How deep you go into it, how detailed the different asset classes would all vary depending on the complexity of the engagement. So that concludes this presentation. I hope the information is quite useful to you. The IPS is a wonderful tool of communicating to your client how you're going to be managing it. I think it's professional, it's systematic, just like the written plan. The same skill sets that you bring in orally presenting that comprehensive financial plan to the client will be applied here. The same skill sets that you used in creating the written comprehensive financial plan will also be applied here. So, best of luck.